All right, so this will be talking about the IPO process and also get into a little bit on dividend policy. So as always, just to start with what we're going to talk about, uh, we're going to talk about venture capital and how that comes about. We're going to talk about the initial public offering. So when the company does actually become publicly traded. We're going to talk about some other procedures that we can use. We're going to talk about sales by the public companies, and then we're going to talk about private placements and those issues. Then we're going to transition a little bit and then move into discussion about payout, dividend payout, right? We talked about a little bit about this before, but a lot more about that. We're going to talk about the information content. Remember, we talked previously about market efficiency and how that's a reflection of how well information gets into the market. And so we're going to talk about what information we get from dividends and repurchase agreements. We're going to talk about the difference between dividends and repurchases and talk about us, doing this. Where it says the rightist and then the radical left, just it's the way it's presented in the book. So we're going to talk about that. It's obviously not meant to, it's tongue in cheek, in the approach. And then the payout policy, as well as the life cycle of the firm. So as we said, they're going to start with venture capital. And so if you've seen the television show Shark Tank, that's probably a lot of people's sort of introduction into venture capital, but you have some sort of business plan. And the idea is through that, I can get some sort of first stage financing. And then if that's going well, the venture capitalist will make additional funds available, right? But the understanding is it's my idea, I came up with this, but since it's their money, they're going to have oversight into what's going on. And one of the ways they control their investment is by staging financing based on hitting certain metrics, right? And so the venture capitalist wants to, have this money and invest it in the new firm. But that new firm's success will be based on those managers, right? So this is that situation where the venture capitalist is coming in with money, but they're going to have to watch over you to make sure you're doing everything possible to make this a success, right? And often what will happen is the venture capitalist will put a lot of restrictions in place with the idea being, I'm going to let you do the stuff that you really understand, but I'm an investor and I really understand business. So I'm going to have a lot more control over that. Right. But, if you're the muffin man, and I'm taking your company, we're going to sell these muffins and, all around the world, then I'll let you focus on muffins and I'll focus on all the capital decisions. Right. That kind of thing. So, yeah. And once the venture capitalist has done this, right, and I grow your little muffin stand into this global company, and I want to raise a lot of money, I can then take this to an initial public offering, right? So the initial public offering, we're just going to first talk about some terms. And so the IPO is initial public offering. If you ever hear IPO, that's what that is. And this is when a stock first becomes available to the public, right? So there's two laws that govern these things in the market. The first is the Securities Act of 1933, and then the second one is the Securities Exchange Act of 1934. And so the 1933 Act is all about IPOs, right? This is how companies would be able to go public. And then the Securities Exchange Act of 1934, that's the one that covers all the secondary market stuff. So the New York Stock Exchange, that type of stuff is all covered in that second law, right? So this right here, when I want to take this and sell it to the public, somebody has to go and verify that everything is correct. All the legal steps are being taken, and that person is the underwriter. Underwriting initially comes from insurance and risk management, and it was you would physically write your name underneath the contract to say, I hold that this will be true, right? And that's where we get underwriting for like insurance contracts and that kind of thing. And so once they come up with that and they're going to take the security, then they're going to say, okay, well, I'm going to sell it, but I have to build in some profit for myself. So I'm going to sell it for whatever the market goes for, but I'm going to pay you a little bit less. And that difference is the spread, right? And that's where the underwriter is getting their profit from. There's a prospectus that we have to put out, and this explains the offering to people. And then under pricing is something that comes up. I want to talk about that. Basically, almost all IPOs end up gaining value in their first day. And we would say whatever gain they have, that is the underpricing, right? It means people would have paid more for it if you would have let them pay more. Underpricing, we know that it really has to occur because it's part of what keeps the market going, because people want to see those returns. But you can't have it too big, because then companies will sue you because they're saying you left too much money on the table because you way underpriced this issue, right? So so that's how all of this, the terms that we're gonna use as we go forward. And this was from the text. I just kind of wanted to point this out. These are the reasons to go public, right? So it's not just, okay, I want to be a publicly traded company. There are, things like enhance the reputation of the company, establish a market price or value for the firm. A lot of these are really clear, but even to minimize our cost of capital, right? If all I can do is borrow or go to venture capitalists, I'm probably going to end up putting myself in a situation where it's going to get more expensive to try to run this thing, right? To allow venture capitalists to cash out, you see it's almost a third, will list that. And that's a real thing, right? Because this is how the venture capitalists get their money back, is when, Sam's Muffins, right, goes public just like Starbucks, and it's worth all this money. They sell their shares, and they may have gone in for relatively little money, but they were there at the beginning. And so they get to write all of that up and they get this huge return. But they understand that most companies are going to fail, right? So the ones that go public make up for all the other ones that just fizzled out because there wasn't a market or timing wasn't right or what have you, right? So, yeah. I mentioned already that we have the underwriter that's doing this, and the spread is the difference in what they're getting and what you're getting, right? That's how they build in theirs. And so here's an example. The issuing company is going to have $1 million in expenses. They're going to sell 3 million shares at $40 each to an underwriter. The underwriter is going to sell the shares at 43 each, right? So just kind of think through, what would the spread be there? And now the underwriters themselves, they can operate in different ways, right? And so here's the big separation that we would talk about is firm commitment versus best efforts. And so firm commitment is basically the contract is set up where the underwriter says, yes, I will take this 100 million shares, right? Like you are guaranteed that they will sell because the underwriters agreed to buy them, right? Best efforts is where the underwriter is going to do everything possible, right? But they're like, look, if we only sell, whatever, 1.5 million of a 2 million issue, well, I did my best, right? Now there obviously lawsuits and things can happen from this, but it's in the underwriter's interest to do their best either way because of the threat of lawsuit. So with a firm commitment, normally the underwriter requires a larger spread because they're taking on more risk, right? Where the other case they would have less risk, and so it would be less. And then the other thing to think about is what we call the flotation cost, because it's not free. We have a lot of paperwork, right? A lot of attorneys get involved. So anytime you have all this thing and you start talking about billable hours and all of that, it's going to get expensive. And so that we're just going to have a cost associated with it, because you have to know, that everything's going to be done the right way. Right. And so this is just an example. a firm has a firm commitment underwriting, there's 250,000 shares. They're going to be priced at 40 to the public. If a 10% underwriting spread has been added, how much are you going to get if you have 600,000 in legal fees, right? And so in this case, you see that the public is getting it for 40, right? Which means the issuer is only getting 36, right? Because that underwriter had to get their 10%, right? And so the issuer is going to get a total of 9,090,000, right, for the 250,000 shares, but then we have to also pull out those legal fees, right? And so this would be what they actually net, where if you just say $40 times 250,000 shares, that should be $10 million, right? But they're getting less than 8.5, right? And part of that's the fees, and part of it is the spread for the underwriter. And what is the underwriter doing to get that? Part of it is their work in getting the issue brought to market, through the regulatory side, but they're also doing the sales, right? They have a selling syndicate that they'll be part of, where you'll have a collection of these investment banks that will find investors, right, that would be wanting to get involved in this as early as possible, right? And that's how they get their prices and all those kind of things, right? Also had mentioned underpricing, right? And so this is an example where they issued them. Let's see, issuer incurs $1 million to sell 3 million shares at 40 each. To an underwriter sells the shares for 43. So they're in the market at $43 each, right? And then by the end of the first day's trading, the stock price is risen to 70, right? So it went from 43 to 70, right, for 3 million shares, right? So that's a $27 difference, right? That's a huge difference, right? You probably have an upset issuer, right? Because they're saying, hey, we could have at least issued it for $50, right, instead of 40. Get somewhat closer, and so this is a real thing that happens, though, this underpricing. There needs to be a little bit there, because again, that's what helps make the market, right? And this is sort of the indirect way of paying the fee to create the market. Okay. Now, when a company that is public, right, when they want to sell securities, right, the one that's a little unusual here, like a seasoned offering, is like we're already publicly traded, we're just doing a new issue. But the shelf registration is basically you file one document. You say, hey, I want to take a total of 2 million, but maybe you don't need all that money right now. So you're just going to take the first 500,000 public, and you have 100 or 1,500,000 remaining. And you kind of think of it as like it's on the shelf, right? As long as I issue it, in the next couple of years, I'll be okay. But I only had to do that paperwork once, right? And it was just with the understanding that you could come back and issue more. They don't want it to be too far in the future, because obviously the company will change over time, right? We can also do international security issues. Now, this would be, as you see from the names, these are bonds, but the bond market is a lot larger than the stock market. And so the two types of bonds that we're going to come across are the Euro bond and the global bond. And so Euro bonds basically get offered like everywhere at once. They call them Euro bonds because the place for investors outside the United States traditionally was Europe. Obviously now the market's more global. The difference between the Euro and the global bond is, like with a global bond, you could sell in the Euro market, but you also have this domestic Brazilian market. And so whatever your domicile is, that's what you would do, right? And then you may have seen this come up when Twitter was first. They were looking at doing a sale. Can current shareholders get additional securities, you know, and that kind of thing. And so this is an example. So Deutsche Bank, it's a bank, it's a real bank, right? They need to raise 8 billion in equity to reduce the debt ratio. And I won't get into all the intricacies, but banks, what we consider to be an asset to them is a liability, right? And what we consider to be liabilities, like our loans, are assets to banks, right? And so banks have restrictions on how much debt they can have total as a firm, because they have this unusual risk profile, right? And so we don't want reverberations through. We've sort of learned our lessons with it on like banks, right? So so they need to raise more equity, and so they're going to go out to the existing shareholders and say, hey, for every 2, we'll let you buy 1 more. And the new shares are going to be 11.65, right? Which is cheaper than what's currently out there, right? So basically, this is going to existing shareholders and saying, hey, will you buy additional shares, right? And so, you know, what would that look like, right? And so it's $18 or €18 before, right? And they'll give you the right to buy a new share for 11.65. And then if you take that offer, how much is it worth? And then, you know, is it a good deal, right? So, so the first thing we got to say is, all right, well, what is it? What do I have right now, right? So the current market value, 2 shares, right, is €36. And then if I do this, I'll buy 1 more share, right? So I'll have a total of 3 shares, right? And then the value of my holdings would be the €36 I had before, plus the 11.65 I pay for the new one. So my total value for those 3 is the 47.65. Okay. So 2 of the shares are worth 18 initially, right? And then this other one is, I'm only paying 11.65 because I'm buying it at this discount, right? Which means the value for each share is 15.88. Right. So for that new share, right, it's that value of 15.88 minus the 11.65 I pay for it, and therefore it's worth to me €4.23. Okay, and so you know, so we would say, like, look, this is a good deal for me. Yes, right. I mean, I'm able to buy it, and even though it dilutes the value of the shares of stock, I'm still better off, right? And so we should do it, you know. And with Twitter, there was some issues about poison pill and stuff. Again, not to get into all those details because it's not part of this chapter, but just understand that that's one of the ways to approach that is through like a rights issue. All right, and so now I'm just going to move on to instead of a public offering, right, something that we call private placement, right? And so with private placement, basically, I'm not selling it to the public, I'm selling it to like a select group of investors. And what we would refer to them as is qualified institutional buyer, right? And basically, it's certain firms and certain very high net worth individuals that basically the SEC says, okay, we will take a hands-off approach because we don't need to protect you as much. Right, that's what this rule is basically saying. We consider you to be sophisticated enough as an investor. You have your own legal expertise you can draw upon. So I'm going to allow you to do a lot more, where the average investor, I'm not going to let them get into these situations because they don't understand the types of risk that they're exposed to, right? So so just understand that exists as well, right? And you could do a private placement and then later have an IPO, you know, so that it doesn't preclude you from doing it later. It's just private placements don't require the paperwork that the IPO does. But if those individuals that bought through the private placement wish to sell to just anyone, it has to be taken public, right? They're restricted in who they can sell it to. Just like they were restricted in their ability to buy it. So, but yeah. All right, so that really covers those IPO, public issue items. And so now I want to kind of talk about the dividend payouts and how that gets treated. And then that would actually conclude module 8. So first, just to talk about payout itself. When we do the payout, we can do it as a dividend, or we can do it by repurchasing stocks, right? But when we do this, you see, I mean, it's some companies never do either, right? They just keep the retained earnings and reinvest it. Almost half of the firms are there. Some do both, right? About a quarter of firms, right? So, this is just to like sort of bring out that we have a lot of different approaches, and we're going to talk about why, right, some of these exist. So this was in the text, and I wanted to point out, if you particularly notice in 2005, there was dividends jumped up, right? So in 2004 and then in 2005, it was much higher. And then also, if you look at the repurchases, they begin to get a lot larger there, right? 2009 is an anomaly, but the 2008 financial crisis is reflected there, right? We had a recession. And so you see this significant drop off, although if you notice dividends stay the same, we'll talk about that in a bit. And then the repurchase, a lot of that was driven by tax policy, right? So we had a change in 2003. I think it's called like the USA Job Act or American Jobs Act or something like that. But allow firms to bring overseas cash back to the United States and not pay taxes as long as they used it for certain investments. And they did that. But that meant that all the money they already had available to pay for those things, they could then just redirect, and a lot of it just got used for repurchases. And so it wasn't the purpose of the law, but that's totally what happened. So that's what you're seeing there. This just dramatic shift. It was because of a change in tax policy. And so sometimes just understand, like that's you can actually see it when you look at the charts. Okay. And so we're going to talk mostly, stock dividends and then cash dividends. Just understand, firms are just trying to pay the shareholders their money, right? And then the dates that we really need to understand, the record date, the declaration date, the payment date, and the ex-dividend date. And it's not that order. So the declaration date happens first, right? That's when they say, okay, now we're going to issue. And then they say, we're going to issue, and this will be the ex-dividend date. And so what that means is on that date, we start trading as if the dividend's already paid, right? And then the next day is the record date. And so everybody that owns the stock on that date, right, they get the dividend check, right? And then the payment date would be after that. Okay, and this is an example when Pfizer paid their dividend for the first quarter, right? They declared it in the previous quarter, right? And they said, okay, we're going to pay 34 cents a share, right? And then in this declaration, they would have stated the ex-dividend date, which was February 1st. Okay, and so on that date, the price of the share would drop by 34 cents immediately. Like that's what happens when it starts to trade ex-dividend. It means it drops 34 cents because that dividend is being incorporated, right? Then the next day, right, the shareholders registered on that date get the dividend, and then they're going to mail that out, at the date specified, right? And so those dates, those always happen in that way. The time between the declaration and ex-dividend, there is some leeway there, and the declaration and payment, there is some leeway there. So you can make your announcement, and not worry so much about counting weekends and that kind of thing. You'll just make sure it's very clear what your dates are. But the ex-dividend record date, this is not really negotiable. These are locked together, right? Okay, and so like that's how we would pay a quarter with the dates like that. The other alternative is to repurchase the stock, right? And so what will happen is the firm would take the money that they would pay in dividends, and instead of paying a dividend to everyone, they basically just will go out and purchase shares from the existing shareholders. So it says here, you can do it on the market. Just go out and just say, okay, we're buying the next 10,000 shares, and they just place the order and buy them. They could just reach out to the shareholders directly and make an offer. You could do what's called a Dutch auction, which is where people will put how much they're willing to sell for, and then you find the price that reaches that and then clears. The difference there is it's a lot better for gaining information. You tend to get a better price. And then the private negotiation green mail, this is where you're basically like, making an offer you can't refuse kind of thing. And why don't you just sell this to me, and we'll make this, it'll save a legal fight, because with your shares and my shares, I control enough of the company. I can do a leverage buyout or something at that point, right? So they call it green mail because it's like blackmail, but you're using just cash to buy them off. So that's why they call it green mail. So you're just giving them a lot of money to get what you want, and to save a lot of legal expense instead. Right, like, let me pay you what I would give my lawyers, kind of situation. All right, so that's how they do the dividends, and repurchase stock is sort of like an alternative to it. And so let's talk about the information content, right? Managers do not like to start paying a dividend and then have to reduce it, right? Because investors freak out. Right. And so if managers raise the dividend rate, you probably are pretty confident that it will stick. Right. Managers do like to smooth dividends. Right. And what that means is they just try, even though they could pay a little more now, it's better just to hold off so that that's available to pay later, again, because of that negative response. Right. And then they focus more on the changes than what the level is. And it just, hopefully that makes sense, just because you have to understand people are very sensitive to it, right? It's kind of like at work, if I went and gave everybody a quarter an hour raise, they'd be like, okay, cool. They wouldn't be really excited, but they'd be like, okay, that's nice, better than nothing or whatever. But if I go and tell them, hey, I'm going to cut your pay by a quarter an hour, they'll just quit. Right. And so, it's sticky in one direction and not the other. Right. And so dividends are like that. Once I start paying it, I can't stop. Okay. And so since we're going out and we're doing this, that does send a signal. Right. And just understand that the manager knows more about this firm than we'll know. Right. And so, like for instance, it says the dividend increase could mean overpriced stock, or it could mean we're about to take off, and so we're just going ahead and setting the new standard. But which one is it, right? Is this thing overvalued and I need to start selling, or is this thing about to take off? And of course, the manager is going to always tell me it's going to take off, right? That's where that asymmetric information comes in, right? I don't know if it is or not, and it's hard to understand the signal. Right. And so, that's part of this. This is from a survey just asking about dividend policy. Right. And if you see, overwhelmingly, they try to avoid reducing the dividend, try to smooth the dividend. We look at what the current dividend is, reluctant to make a change that has to be reversed. Right. Because you just have to understand, it's 2/3 said we consider the change in the dividend. It's really clear from the ones they think about a lot more that change is going up, not down. Right. They definitely try to avoid that. So yeah, it's just to get you thinking about dividend policy in that way. Now, Modigliani and Miller, they had a lot of work where they looked at capital structure, found that people didn't really care how the company is levered, because they can unlever or lever up on their own using their own borrowing. So they also found, looking at income, that as an investor, if there's no taxes, you don't care about the dividend payout, right? Whether they pay you a dividend or they do some sort of stock repurchase, you just will not care as long as there's no taxes, right? That's like one of those assumptions that's baked into it. But yeah, so this is like just an example looking at two different ones. So the first one is, you have $1 million in cash, and then 11 million is your market cap. And then I pay out $1 million in cash. So later you see the surplus class goes from 1 million down to 0, right? So if my assets fell to 10 million, my liability side, right, must go to 10 million. And so the market cap went from 11 to 10, right? So I paid $1 million. The value of the shares dropped by $1 million, right? So as an investor, yeah, we got paid, but my stock price fell by the same amount that we got paid. Just like with the ex-dividend date, and I said, okay, now the stock price would just drop 43 cents, right? Just automatically, because they're going to pay 43 cents, and so the market cap has to drop by the exact same amount, right? So, yeah, just to show that's why we're indifferent. This is, excuse me. We can do the same calculations that we've been doing, the discounted cash flow model, right, to come up with a stock price. We would be able to do that the same way with these new shares, right? So let me show you sort of like as a graph what that looks like, right? And if you see, right, the total value of the firm doesn't change from before the dividend to after the dividend, right? And so we had the 4 shares or whatever before, and then afterward we're going to have 6, right? And you see each share is going to have to drop because we have that many more that it's spread out over, right? And so the total value of the firm doesn't change. So if the number of shares increases, the value per share has to decrease by the same amount. And if it goes the other way, if we decrease the number of shares, like through the stock repurchasing, then the value for each must go up. So, okay. Here's a different way of thinking of the same thing. The firm, right, is going to give shares to new stockholders. And then by issuing that stock, then they paid cash, which you could just then pay to the old stockholders, right? Now, if you see what happened, the new stockholders got shares and then they paid cash, but the firm just acted basically as their own middleman. And if you see, if there was no dividend, no stock issue, they could just be in the market and they would pay cash and get shares. So it works out the same, like either way. So again, this is why we say that people don't have a preference, right? Because it ends up being the same mathematically, right? And so this is that part that I said was going to be a little tongue in cheek, talking about like this right view and left view or whatever. So if you think about, let me just go ahead and skip to the next slide, actually, right? And so you should really think about the dividend as a signal, right? If you increase your dividend, it says, hey, things are going to go good. If I cut a dividend, that is seen as being tragic, because if I missed my dividend payment, they're sure I would have tried really hard. And so I still missed it. It must be pretty bad, right? And so because of that, right, and it's too costly, I can't just bluff with a large dividend, right? Like that's a costly signal, right? So by putting that out there, it's a costly signal, and so people would believe it, right? And then the other big thing is the tax consequences. So capital gains and qualified dividends get taxed differently than income, right? And based on these different levels of taxes, firms should put their payout policy to best fit the tax code, right? And so even with taxes, right, the person that's more on the right would want this to happen, so that I'm maximizing my value, right? And so I'd rather you keep it and invest it and grow my value than pay me the dividend and I have to pay taxes on it, right? So that would, like, if you think of it more as a right wing view, where a left wing approach or what have you would be focusing on the tax, right? And so because of the taxes, then the dividend policy should adjust again to that, based solely on what makes the most sense for the owner, right? As the manager, I'm trying to maximize their value. So if you are a left-wing person and you're trying to maximize taxes to take money from the company to invest in social programs or whatever, right? Then you just understand that the companies are going to naturally adjust for whatever your tax code is, right? So I don't know, the book tried to approach it sort of this right wing, left wing thing. I don't know if it helped a lot, but just wanted to talk over that in case it was confusing. So now, as far as looking at, do taxes actually affect people's decisions? And the answer is yes, right? About a fifth of US financial managers say, look, we have to think about taxes, right? When we look at what yields are, right, you can definitely see where taxes are being incorporated there, right? And in areas like in the United States, we are taxed twice. And so this is just to look at that. When you look at the corporation, first pays a 21% tax. So instead of getting $100, I only get 79, but then I got to pay a 15% tax. So that's another 1185. So even though it should be $100, I'm only getting 67, right? So that's a lot of being taken up in taxes. So this is just comparing, how different levels of taxes. So it's a 15, 30, and 47% bracket. This is in Australia. And this is where you see how, like in Australia, they actually give you back credit for what the corporation already paid in taxes to avoid that double taxation, right? And so you're able to see, that play out, in this case, right? So, and then wanted to talk a little bit about the payout policy and the life cycle of the firm, right? Because when we're thinking about a startup company, right, then when you're trying to get debt, you have to understand we have this possibility of like debt overhang where I'm paying all this bad debt, and because I have this debt that's already outstanding, it's hard for me to raise new debt, even though it'd be a great program. I just can't get the capital, right? And so these are the kinds of questions that we're going to ask, given where we are as a company, right? When I only have one store, it's different than when I have 5 stores, right? And so we just need to understand that and just be prepared, right? A lot of this is risk management, right? And so just to conclude, payout with the corporate governance piece. It's, you know, the first bullet point, payout can be important in countries where there's less effective government or more opaque corporations, because it is a costly signal, right? You're guaranteeing me basically $3 a share, right? So even though I can't necessarily see all your books, I know whether or not you're paying $3 every quarter or whatever, you know, the policy is. So, and so by having that costly signal, I can trust it. So, but yeah, and so like that's, it provides that level of overwatch that you wouldn't necessarily have. So that's the it for chapter or module 8. So thank you so much.